I bet. Let's get into it. Market maker models. So market maker models is essentially how the market moves consistently every single time. It's since time is fractal, you're going to see a market maker model in every single time frame. And how a market maker model looks or is you're going to have a market maker sell model and a market maker buy model, right? So for this here is your market maker sell model. And then here is going to be your market maker buy model here. God, I kind of like shit on this one, but something like this is going to be your market maker sell model. So right here, and this is going to be your buy model here. Buy model. Okay, it's going to be a buy model here. And basically they're just inversed. So if you take this and inverse it, that's going to be your buy model. Now these are available on all time frames. You're going to see it on the 1 minute, you can see it on the 5 minute, 15 hourly, 4 hour, daily, weekly, etc. So you're going to see this on all time frames. And how it basically works is you're going to have two sides of the curve in your sell model. You're going to have the buy side of the curve and the sell side of the curve here, right? You're going to have it's not really a curve, but it's going to look something like this. You're going to have like a little curve for the buy model here, and you're going to have another curve here for the sell model, for the sell side of the curve. So the buy side of the curve, the sell side of the curve, and vice versa here. So how do these market maker models start? Generally, you'll see them start with something called an OC or an original consolidation, and that's going to be most likely the terminus of the sell model or the buy model. And in terms of fractality, it's going to come out of a higher time frame PD array. So let's first go over the times, and then we'll kind of dive into exactly showing when they're going to happen. Most of these are time based, especially when it comes out of those weekly or those higher time frame PD arrays. It's definitely going to be time based, especially when you come also looking at the lower models. And when it's not exactly super duper clean like this, they're not going to be this clean, but all the time, but they're generally going to be around the same thing every single time. We're going to see them in every single time frame. So let's kind of go in through the time frames, and then let's look at the PDA matrix that ICT gives us that's going to help us formulate this market maker model. So the times that we generally want to use here is I'm not going to go higher than the monthly here, but it theoretically keeps going up from there. But theoretically, from the monthly time frame, you want to see it come down to the daily time frame. Then you want to see that come down to the hourly time frame. Then you want to see that come down to the 5 minute time frame and that into the 30-second time frame. So this is going to be times for your market maker models here and the fractality of it. And I'll kind of go over this on a second here. And now for the other way around, or not the other way around, but another time window you can use for this is the weekly. And the weekly goes down to the 4 hour. And the 4 hour goes down to the 15 minute. 15 minute goes down to the 1 minute. And the 1 minute generally can go down to the 15 second to 5 second. But I wouldn't put a whole bunch of emphasis on this 15 second to 5 second. So I'm just going to leave it at the 1 minute for now, just to keep things simple. And this is the times that we're going to be looking at. So what this is basically saying is that from a monthly PD array, for example, a monthly fair value gap, you're going to see a daily sell model or buy model, right? You're going to see a sell model or a buy model, right? Now, sorry.
Because it's
Anyways,
getting
so
limited.
yeah, exactly. So from a monthly PD array, mostly a fair value gap, down to a daily, that's when you're going to see a daily sell model or buy model, right? And the same thing goes from a daily fair value gap, you're going to see an hourly sell model or buy model. right? Like so, right? And the same thing keeps going from the hourly and the hourly fair value gap. You're going to see a 5-minute sell or buy model. And from a 5-minute fair value gap, you're going to see a 30-second buy or sell model here. And we can apply the same exact thing here to the weekly and the 4 hour. From weekly fair value gap, you're going to see a 4 hour model. Now, once again, I should clarify, it doesn't have to be a fair value gap. It can be an order block. It could be a weekly high or low. It could really be any possible PD array weekly rejection block, right? It could be anything. It's not specific, right? From a 4 hour fair value gap or 4 hour liquidity pool, you're gonna see a 15-minute buy model, and from the 15-minute fair value gap or 15-minute liquidity, 15-minute order block, whatever, you're gonna see that happen just like this. So let's go over what the sell models and the buy models look like. Then we'll go over how we can look at it through the elements of these times, going through the fair value gaps and kind of looking for the buy models out of that, and a whole bunch of other different things we can go over with the models. So this is generally how it's going to work. You're going to have your buy side part of the curve here, and this is going to be what is going to set your sell model, right? So this is going to be the start of the sell model here. And in here, you're going to generate a lot of bullish PD arrays, like the fair value gaps. You're going to see price react off of here. You're going to see a whole bunch of other PD arrays, and you're going to assume these are eventually going to get inverse. Not only are you going to see these PD arrays here, you're also going to be seeing forms of liquidity, like liquidity here, and your original consolidation liquidity down here, right? This liquidity here, and then your original consolidation liquidity here. Now, not all of the times are we going to find our terminus or the end of the sell model be here. There are times where you're going to find it, depends on what the market wants to do. You're going to find it end at the equilibrium level. You can find it end down at this low. You can find it ending at the 2 to 2.5 standard deviation range here and not come down here. But let's go over exactly what we want to see for this sell model first, right? So at the top of a sell model, and this is ideally what's going to happen. Let's say this is on the 4 hour time frame, okay? I'm just going to move all of this here over to the side so we can kind of focus on what I really want us to focus here, and that's a sell model, and we'll kind of do the same thing for the buy model as well, right? So this is what you want to see for a 4 hour time frame market maker sell model. You want to see ideally a weekly liquidity pool swept here, weekly swing high, or you want to see a weekly SIBI. In this case, I'll use a weekly SIBI. You want to see those weekly SIBI come into play here. Once you see this weekly SIBI up here, you want to look for your smart money reversal here. Now, what are we going to classify as a smart money reversal? Very simply put, you want to look for that market structure shift and that breaker block, okay? Or that breaker block or a mitigation block, right? So that's what we want to look for. And really quickly, I'm going to bring up ICT's PDA matrix really quickly. Let me see if I can find the picture of it. Let me see if I can find a good picture of it. Give me a second here. Like, these are all fucking terrible pictures. Give me a sec. Okay, here we go. This is our PDA matrix here. And basically what this is saying is this is going to be our, get the GAN box here. Let me see if I can find it. I don't know where it is, but give me a second here. You can try and make this look as nice as possible. Here it is. Okay. So, okay, this is basically what we're looking at here, where this is going to be equilibrium of the implied dealing range. Implied meaning that we're assuming this is going to be the sell model down to this original consolidation down here, right? And these are where each PD array is supposed to form in the exact order, right? You're supposed to have your high, low get put in place here. You're supposed to have your rejection block get put in place. then your bearish order block, then your bearish fair value gap, then your bearish liquidity void here, your bearish breaker, and your bearish mitigation is all supposed to form in this part right here in the premium section for the sell model here. And then you're supposed to have, and it's going to be the same thing for the buy model, but it's going to be on this end, and you're going to assume that there is going to be a bullish mitigation block, then a bullish breaker, then a bullish liquidity void, then a bullish fair value gap, a bullish order block, a bullish rejection block, and then an old low, and that's the way it's supposed to go downhill here. I'm not going to put too much emphasis on that, but when you are looking at this, just make sure you understand these are in the order of which each PD array should form. So let's get right back into our model here, right? So now ideally, when you are looking into the sell model, we want to be taking our entries either in the premium or in the discount here. If we're shorting, we want to short in a premium. If we're longing, we want to long in a discount, right? So after we create the smart money reversal here, right, what do we want to see when it comes to your sell model? Well, we want to start seeing these bullish PD arrays get disrespected here, right? What caused this leg up? Most likely a bullish fair value gap. You want to see these start to get inversed here, right? Every PD array has an inversion, and this is what you want to see inversed, right? We want to see this bullish fair value gap get inversed here, right? And we want to also see our bearish PD array starting to form, as well as our bearish, as well as inversing these PD arrays. Now, when would I start putting emphasis on these inversion PD arrays? I want, if you are looking to take an entry off an inversion PD array, make sure it is in the premium or in the discount, right? Because this is where you want to see the inversion start happening to start this sell model. And where can it possibly end? The equilibrium point here. Now, when we have this equilibrium point, you still want to see these premium arrays or these premium PD arrays, like a fair value gap, get inversed, but it does not have to. Okay? It does not have to get inversed here. So let's keep going with this sell model, right? We want to see that breaker block form, and this is all going to form inside of this smart money reversal here, right? And the idea is the smart money reversal is going to give you kind of two to three kind of entries that you can possibly get. You're going to get your low risk buy, your low risk sell, first stage of distribution, and second stage of distribution, right? So your first stage of distribution, your low risk sell, it's going to be somewhere up here before we shift the structure and before we start inversing these PD arrays. Your first low risk sell could be possibly a fair value gap that's somewhere here, right? And price kind of comes into it like this and then continues its way down and follows the same path here, right? And this could be your first low risk sell. Your first stage of distribution is going to be right here, right? Generally, it's going to be on the breaker block, possibly a fair value gap intertwined, possibly a inversion fair value gap here. Now, this doesn't have to happen all the time. Price sometimes will not come into a breaker block. Sometimes price will just completely leave you, and that's fine, right? Maybe you're not 100% confident price is still going to go lower. That's when the second stage of distribution begins. And the idea is the second stage of distribution is supposed to come up just right. It's going to be around equilibrium, but you want to make sure it's just above or just below. If you're looking to sell, you want to make sure it's still in a premium. If you're looking to buy, you want to make sure it's still in a discount here. So your second stage distribution is going to be after we react the first time. So you're going to have your low risk sell, which would be somewhere up here. You're going to have your first stage of distribution, which is going to come into a breaker with something around here after we shift structure. And your second one is going to be right before we make kind of our last move down here, and it's going to be kind of the last entry possible in a premium or in a discount, whichever you want to do. So the idea here is you're going to have a fair value gap here, and you're going to have a bullish mitigation here. And this is the idea behind the second stage of distribution when it comes to taking your second stage of distribution trade, right? So now you have three possible options to get into the trade here. You have your low risk sell, which is somewhere up here. You have your breaker block, first stage of distribution, second stage of distribution, which is going to be this leg right here, right above the premium. Now, it doesn't always have to happen, but this is your ideal situation. And then you're going to have, finally, that second stage of distribution is going to take us down to the original consolidation. Now, does it always have to do this? No, it does not, right? We could end the sell model here. The sell model could be ended here. It does not have to go lower to this original consolidation if the overall higher time frame is still bullish, right? So just remember that. Now, it's going to be the exact same thing when it comes to the buy model. This time, we'll look at a 1 minute buy model here. So a 1 minute buy model And we want to look for this 1 minute buy model, right? What does it have to come out of? If we remember our time charts here, right? It has to come out of this 15M BISI here, right? So you want to see it come into that 15-minute BISI. We're going to see the smart money reversal here, right? Generally, you're going to see your shift in structure, your breaker block, right? Then this is your first stage of distribution, and your second stage of distribution is going to be here, and this is going to be your next point of entry. That's possible for you to get entry up to this original consolidation. Now, where do you want to see the original consolidation align up with when it comes to standard deviation points? Well, if we're looking at standard deviation points, you want to see your original consolidation lie between the 2 to 2.5 or the 4. Ideally, I would have it at the 2 to 2.5 here, and ideally you want your this liquidity point, this short-term low here around the equilibrium point to be aligned between the 1.5 to 1 standard deviation level. And these are going to be your 2 take profit points, right? The idea behind this is if you are targeting the first stage of distribution here, your target should be here. This is the general idea. Yes, you can hold for here if you're confident, but the general idea is you want to hold out for this 1 to 1.5 area, and there's nothing wrong with that, right? And the idea is if you're going in for your second stage of distribution, you're going to hold up to that 2 to 2.5 area, and that's generally the case for most of the buy models. So do we have any questions about the buy model so far? If not, we can start moving into some live examples here. I have a live example here on the 4-hour that we can look into. So let's look at this 4-hour sell model here, and this would be kind of a good opportunity to study this, and then we'll kind of go over and we'll look at some other pairs. I know the JPY had a really good one on the higher time frame, and then we can look at some lower time frame ones. Okay, some of the ones that we may look at today are going to be really choppy and really kind of hard to read here, but that's kind of the idea behind it. Not all sell models and buy models and market maker models are going to be super clean. So let's look at this right here. I'm just going to mark this out right here with a line here just to see. So since we're on the 4-hour chart, we're going to look at the weekly chart here. What do we see here on the weekly? We don't really see much here on the weekly, right? Besides that, we took out this weekly liquidity here. Nothing's really telling us that we want to start this sell model, but that's perfectly fine. We don't necessarily need that higher time frame context here, right? I'm just going to mark out this one weekly order block here, just so we can know where that kind of starts here and when you guys can see this. But let's just look at the 4-hour time frame for now. All right, so since we are at all-time highs, we don't really have a PD array to go with here. So we'll look later for another PD array when it comes to this. Your 4-hour buy model. What did we say the sell model looks like, right? You could have your original consolidation, and you're gonna have something like this where you're gonna have your smart money reversal, and then it's gonna come down to this original consolidation low here, right? If we look at this here, right, we can pretty much estimate that this is most likely going to be original consolidation. Is a little consolidation point here, right? So we can mark this out as our original consolidation points. Beautiful, right? Now, what do we see here? We see our original consolidation. We see 1, retrace into the fair value gap, 2, 3, 4, come up here. This right here did not react off a fair value gap, but that's fine, right? This is going to mark your shift in structure and your breaker block, right? And this is going to mark your smart money reversal right here. So this is one of your opportunities to go short right here. This is your first stage of distribution short here. I'm going to line up our standard deviations here, just like so, right? Now, what's your target if you're entering off of here? If you're entering off this unicorn to go into your sell model, well, your first target would be here, right? Or possibly your terminus, depending on how, it's not the swing low, sorry, depending on how much you trust the sell model. If you do think we're going to go down here, then there's nothing wrong with holding it down here. But generally, what I would say if you guys are just getting into your market maker models, look at the first stage of distribution and look at it to take down to this swing low here. And what did I say the swing low should add up to? Basically, it should come up to the 1 to 1.5 standard deviation level, and that's what you see right here. Now let's look at for your second stage of distribution. This is going to be generally the safer option because you're now going to have more context in the direction, and if this is truly a sell model or if this is just not a sell model and you were wrong, right? This is your second stage of distribution here. Now your bullish mitigation block is up here, right? So unfortunately we do not come up to it here, right? But you also do have another mitigation block here, right? And this is generally what I said in the other picture again, right? You're gonna have your next mitigation block here, right? Somewhere around by that fair value gap, and it doesn't have to come up and touch it. You just generally want to see it. So this old liquidity point basically is gonna act as your mitigation block, right? Where you're gonna take this to, you're gonna take it off the fair value gap here, right? And you're gonna want to target the original consolidation low, which just so happens to be in that 2 to 2.5 zone. Okay, do we have any questions about this sell model right here? Cool. If we have no questions about this sell model here, of course, this sell model ended up going a little bit further, all the way down to this low, taking out this liquidity here, right? But what we're probably gonna see here is I don't know if I have the data to go all the way back here, but let's come and take a look at this 4 hour right here. This 4 hour SIBI down to this original consolidation low here. Let's come into the 15-minute time frame here, and let's kind of see what we're working with here, right? Inside of this 15-minute time frame, you inside of this 4 hour BISI, it's not as clean on NQ as it's going to be on Forex pair. So I'll go over the Forex pair, and like I said, it's going to be nasty, right? There's going to be some models that just look fucking nasty, and these are going to be pretty much some of them. It's not always going to be this clean, right? So what do you see happen here, right? Inside of this 4 hour, right? Um, we did have SMT here, so just note that as a fact. We had SMT here, okay? So now that means we don't have to take out this high. But inside of this 4 hour, we want to look at the 15-minute time frame, right? Come into the 15-minute here. This one here gives you your low risk sell opportunity, right? As your breaker block is right here, this gives you the low risk sell opportunity. Boom. Next comes your first stage of distribution, which is down here. And then your second stage of distribution kind of happens right here. But once again, super, super nasty, right? Second stage of distribution here down to the original consolidation lows here, right? Let's run our standard deviations here, right? Once again, 2 to 2.5 lines up really well. Now since this is super nasty, you don't really have that short-term low in that 1 to 1.5 here. You can consider it this one right here, but this just shows you how it's not going to be as easy as it is, right? So if you're taking that first stage of distribution here, get in on that breaker right there, right? You can target here. If you're getting in on your second stage of distribution here, right, you want to target here. And look how the standard deviations line up every time. 1 to 1.5 is a short-term low here, right? 2 to 2.5 right here is going to be your final terminus or your original consolidation right here. Good. Do we have any questions about the sell model? Coming down to the lower time frame? No? Cool. Okay, let's look at a buy model now, and we'll kind of look at it. Let's look at it on the JPY real quick, because I know the JPY had a really clean one, right? And this it'll be kind of better for an example, right? But once again, these are applicable. If I'm showing this to you on USD JPY, it's also going to be there on that it's also going to be there on NQ and whatnot, right? And we'll do one more on USD JPY just to kind of show you guys another clean version of it, and then we'll kind of drop down and we'll go back to NQ and we'll look for like a lower time frame on like a 1 minute or a 5 minute one, right? So let's look here. We're on the weekly time frame here, right? Let's just mark out our weekly fair value gap, which we have this one right here, right? And let's just mark out our weekly external low, which would be this one, as well as a relative equal low here, right? Off the weekly, let's come down into the 4 hour and kind of see what we're dealing with. Actually, no, it was the buy model that we wanted to look at. Sorry, my fault, guys. Okay, so look, we came down into here, and this is your weekly liquidity pool. Like I said, does not have to come off a PD array every single time. It can come off a weekly liquidity pool. This is a weekly swing low, so you can expect to see another buy model come out of the weekly swing low. Come into the 4 hour time frame here. Let's look at our buy model, right? This is generally a clean buy model here, right? So let's look at what we have here. You're going to have your sell side of the curve here, and you'd have your buy side of the curve here, right? This is generally what it's going to look like, right? So what can we do here? Let's run our standard deviations off the smart money reversal here. So let's look to run our standard deviations here. Right, so let's look here. 2 to 2.5, not exactly the perfect lineup here, but we can see it's in the general vicinity here, and you can see your 1 to 1.5 short-term high. It's going to be right here, okay? So I'm just going to mark these two out as liquidity. And now it does not always have to line up here, guys, but if you guys do want to see a super awesome seller buy model, you generally want to see it line up here. If you guys wanted to use this breaker, you could. This one is going to be your overall market structure one here, though. So what are we going to see here, right? Before this breaker forms here, the breaker forms right here, right? You're going to see your low risk sell or your low risk buy opportunity. And it's going to come in right here, right? And you're going to see the inversion of a fair value gap down here after coming into PD rate, taking a low, whatever, right? You can see that inversion fair value gap. Look at the body stay. Look at the body stay inside of that inversion fair value gap here, right? So you see that inversion fair value gap. You see this one right here. This is your low risk buy opportunity, right? This is your first buy opportunity here. When it stops at the low, stops down here, whatever you want to put it, right? This is your first buy opportunity. Where's your first stage of distribution? Second buy opportunity. It's going to be right here with this breaker block here, right? Right here. This is your second buying opportunity right here. Let's buy in this fair value gap here. Let's put out a stop loss. Since it's a big wick, we can put it around consequent encroachment of it, right? And we can target the 1 to 1.5 liquidity pool right here, right? Price runs up, comes down. This is some insane news driver, so don't worry about that. Comes back up and eventually reaches its first terminus. Now, great. We reached our first terminus. Now, what should we do after this? After this happens, we reach that 1 to 1.5 short-term liquidity pool here, right? We swept this, right? After we sweep it, what are we looking for? Well, you're looking for your second stage of distribution here, which we see it off of this fair value gap here. This is a super tiny one. If you want to take it, you could, but look at it off this fair value gap here, assuming this is going to be your breakaway gap, stops below consequent encroachment of that fair value gap, and then we're going to finally target the original consolidation high, which is going to be right here. Doesn't quite align with the 2 to 2.5. If you want to, you could take it up to this 2 standard deviation level here, or you could take it up to this high here, but they're not guaranteed, right? The safest option is to take it right here. Now, where's your mitigation block? Your mitigation block is right here. And boom, this is going to be basically your market maker buy model coming out of a weekly liquidity pool. Do we have any questions about that now? Okay, we have no questions here. Let's move back on to NQ here and we'll look for another sell model coming up off of here. And we'll look at that 15-minute to down to the 1-minute sell model here, right? So 15-minute fair value gap here. Let's come down into this 1-minute time frame now, right? What do we see here out of this 15-minute fair value gap here? Well, you're going to see your first low risk sell here, right? Low risk sell is right here. Oh, fuck, I accidentally switched over. Not fault lines. Hold on. And spin back. Where were we? Okay, right here. Yep. So you have your first low risk sell right here. This is your first low risk sell opportunity right here, right? And you want to take that down to around the 1 to 1.5 place, exactly kind of where you want to take it down to with the low risk with the first stage of distribution here. But let's look at where we shifted our structure and made our breaker block here, right? Where we shifted our structure, we made our breaker block here, right? Your little unicorn model is here, right? Super choppy, right? It's not going to be super clean as always, but, right, what do we see here? Right, we can now start to draw our standard deviations here since we have a really bad market structure point. It's going to probably end around the 1 to 1.5 here. So once again, it's not going to be your cleanest, but you guys are just going to have to make do with it, right? This is your original consolidation. So just a little bit of consolidation before you run up. 1, 2, 3. Smart money reversal right here. Low risk sell. Boom. First stage of distribution here. If you wanted to take it off of here, your stop loss probably would have been above this high here. You would have been stopped out, but let's say your stop loss was safe, somewhere safe like up here, right? You managed to enter. and that's where it brings you down. And this is why I like to go after the second stage of distribution here, because you're not always going to get that, right? Because this first stage of distribution is not always going to be the super cleanest, right? And there are going to be times where you're just going to get stopped on like this. So this is why I like to wait for the second stage of distribution to get into my trade. Now, where is your second stage of distribution going to get put into place here? It's going to be, you want to wait for more confirmation, right? Me personally, I would probably enter somewhere around here, right inside of this macro time right here. But you also do have this one little fair value gap down here, right? That you can use, assuming this is your short-term low here. That's going to get taken here, right? We're assuming this is the short-term low that's going to get taken from here, right? This is your next short-term low here. Sorry, my fault. It's going to be down here, right? We see get taken. Now we see a retrace back up into the fair value gap here, and it's finally, and that sends us lower down to this original consolidation low here, right? So this generally is going to be where your second stage of distribution is. This is your first stage of distribution. This is your low risk sell. Okay, we can look for another one. We can look for another sell model here. Let's see if it comes out of a 5-minute fair value gap or some kind of fair value gap that we can imagine. No, but we can say it comes out of this 5-minute high here, right? Doesn't have to be a 5-minute fair value gap. 5-minute high right here. 5-minute CE wick. 5-minute fair value gap here. 5-minute unmitigated part of the fair value gap right here. Right? So we come up into the unmitigated part of this fair value gap here. We sweep this high. Let's come down to 30-second. Right? We come up into this fair value gap here. We start to sell down here. You get your lowest sell right here. Now, why is this your lowest sell here? Because this is going to be your breaker block right here, right? And you don't quite get that. When you come into here. You do get the sweep below this low here, but this is going to be your low risk sell here, right? We can run off standard deviations from here to here again, right? Now again, standard deviations don't quite line up. You don't quite get this low down here. I believe it was some kind of SMT here, something like this, that caused us to not get this low here. So just remember that. Remember, we're also coming up to election, so it's not looking super clean, but you can see that right there. So your low risk sell here, your first stage of distribution would be right here, either getting at this fair value gap or getting at the breaker block here. You guys can choose, right? Come down, right? Where's that short-term low you guys are looking to take out and then to re-enter here, right? Short-term low right here. You see that short-term low get taken out, right? Where's your next entry? On the very next fair value gap that comes after we take out that short-term low here. This is your next sell, right? You can have something like this, right? Ideally, you want to target here, but of course, let's take your partials. Let's take out partials here. Let's get ourselves paid. Let's take out partials here, right? Maybe let's take out partial right here. Let's take it right here. Let's take at least one partial, right? Price does not quite reach it here. You end up getting stopped out at break even, but right, at least you got your partial done and you got in on your second stage of distribution, even when you're not 100% confident here, right? And this can also be a 15-minute sell model here too, 15-minute down to a 1 here, right? This is your unmitigated part of your 15-minute fair value gap here. Come down into your 1. Since time is fractal, we're generally going to see the same exact thing, right? This is your 15-minute high that gets swept right here. Boom. Here, you don't quite have a low risk sell here, so don't worry about that too much here, right? You have your breaker block get formed right here. Boom, right? Your breaker block, no fair value gap in here, but you could take this off. This is still your first stage of distribution, or if you want to come down into right here, make sure this is your first stage of distribution here, right? Finally, you come take out this short-term low here, right? You take out the short-term low, you look for that fair value gap here. Boom, this is your second entry, boom, right here, right? What can you also do? You can also line up this inverse fair value gap here. It is actually the trade that I took right here. I got stopped out at break even here. I ended up buying right at the top right here. Why did I buy here? Well, I was looking at this consequent encroachment of this wick here, like that. And I was also looking at that 830 open, which was just around right here. So I bought somewhere around right here, right? This was my entry short. I was looking to get this low here. I ended up getting stopped out at break even here. But Yeah, this is your second stage of distribution entry right here, right? First stage of distribution, low risk sell will happen somewhere up here. Happened on the 30-second, didn't see it on the 1 minute. Second stage of distribution, and you can see just how fractalized time is. We saw it off that 5 minute fair value gap down to the 30-second, and we now see it again from that 1 minute fair value, from that 15-minute down to the 1 minute, right? So, any questions? No, it can totally happen, but like back to back. Like right here, we see a back to back sell model, back to a buy model here. Now, exactly not the cleanest here. I'll come and show you it on the 4 hour, so it looks a little cleaner, right? We have your 4 hour sell model right here that we kind of marked out, and then you have your buy model right here, right? Again, low risk buy here before we form that breaker right here, right? Then we form our breaker somewhere. Actually, your breaker would kind of be this one here. You form your breaker here. Price doesn't quite tap into it here, right? But you can see we had the sell side of the curve here, and now we're forming the next part of the curve here. Smart money reversal here, smart money reversal here, right? Remember what I said we want it to look like here, right? Something like this, right? And there's nothing wrong with it doing something like this and doing the very next sell model, and that's perfectly fine, right? Boom and boom. Yep. What are the best intraday conditions for MXSM? I really like to see them on like NFP days, CPI days, PPI days. This is when I think they are the cleanest and they are the best. But they generally happen every single day. I would look for high probability days with red folder news. Like I know this whole entire week had basically no red folder news but Thursday, so it's going to be a little bit choppy. It's going to be a little bit bad price action. But they're still there, and once again, they're just not gonna be super, super fucking clean. They're just fucking ugly as shit, and it makes it kind of hard to read. But I would look for ones where there's a good amount of news events, right? Maybe like a Thursday with unemployment claims and a couple other things, right? Any general good day with with some red folder news that's gonna bring in some volatility into the market, right? With nothing that's gonna make it low probability coming up. Now we are getting into close to election, so the probabilities are lowering every single day as we get closer. So there's that. And then we'll go over to see, I'll show you what the 4 hour sell to buy model kind of looks like here. So actually go back to JPY, I think. Nah, actually, fuck it, we'll keep it here. But yeah, you can just see, so let's say we took out this weekly low, right? Remember we saw the sell model from up here, right? We saw the sell model from up here, sell model finished down here. What do we immediately start again? We start our next buy model. Again, not super clean, right? In this case, we use the mitigation block here, right? Low risk sell here. First stage of distribution here. Second stage of distribution here, right? Right before we take out this high. Take out the high off the second stage of distribution. What do we see happen again? What does this look like exactly? What does this look like? Looks exactly like this, right? Does this not look super duper familiar here? Do these two not look super, super similar, right? So you get this sell model, you get this really nasty, not really clean buy model here, right? Then you get the sell model again. It looks almost identical here. Boom, breaker block, fair value gap, sell lower, right? Sell lower, right? Whereas the terminus in terms of this one here, right? We can look at that equilibrium level, ended right around this equilibrium level. And what do you see again? We start our next market maker buy model back up to this high here, right? So we come down to equilibrium here. Then you see your next market maker some buy model up, right? Let's look at this. And we can just constantly be running the standard deviations here, right? 2 to 2.5 here. This is where we're kind of rejecting this area right here, right? We can run the standard deviation levels here. That would be this one right here. This one ended up around the 4 to 4.5 here, right? You can run your standard deviation levels from here, right? Where was this high? Off this mitigation block here. Just past the 2 to 2.5, but where did we reject? 2 to 2.5 here, right? Look at this one here. What happened with this one here? right? We ended here. This was the OC here, 2 to 2.5 here, right? And then we came down to the 4. What happened at the 4? This 4 area, we did have a little bit of a consolidation and then a Judah swing up. So at your 4 standard deviations, you could have your Judah swing, right? Boom, Judah swing, and then you continue down. Hedging positions, what do you mean? Like buying and like on top step going long and on MFF going short? Is that what you mean by hedging? You mean like pyramiding? Okay, yeah, sure. We can get on to how to properly pyramid. Yeah, hedging is where like on top step you'll go long and then on like a MFF you'll go short. So basically one you lose one and then you'll win on the other. So that's basically what hedging is. But how do we properly yeah, how do we properly um pyramid? Okay, I'm losing my words. How do we properly pyramid? We're gonna be pyramiding on order blocks, right? So the idea is you want a pyramid if you're assuming this is gonna be your terminus down here, right? You want a pyramid, you're only gonna pyramid above equilibrium here. So anything below equilibrium, you're not going to pyramid. If you take a partial, you're not pyramiding after you take a partial, okay? So these are the only times you're going to pyramid. So let's say you get in here at this breaker block right here. Lowest close body here. So this is your breaker block here. And boom, you get in at your breaker block. I'm looking for another entry. Where am I doing my pyramids? I'm doing pyramids on order blocks only. Okay. So I'll look for pyramid opportunity here. I don't get this pyramid opportunity here. Where's the next order block that forms in the premium here? If I'm super confident price is coming down, boom, I'm going to add to my position here, right? This is going to dollar cost my position right here. And now you have one of two opportunities when it comes to this, right? There are two things you want to have an idea of when you want a pyramid, right? You want to make sure you're pyramiding so that your dollar cost average is not going to be super terrible. So you want to have bulk of your position be here. So for example, let's say you wanted to trade a total of 10 micros, you'll go in possibly like 6 micros here and then 4 micros down here. So your dollar cost average stays up a little bit. And the idea is, right, once this happens, let's say you're risking $300 with a stop loss at right here, right? Let's say this was your trade, something like this, right? This was your trade, you're risking $300 here with 6 micros, right? And you pyramid right here. Now you have one or two options, right? You either can move your stop to break even, which I wouldn't do if you're pyramiding, or you move your stop to where you'll have another $300 of risk, this time with 10 micros. So it would be pretty much about where your old entry was, which would make it break even. So that's kind of where you want to be when it comes to pyramiding. You want to make sure that when you pyramid, your dollar cost average makes it so that you're risking the same, but you have more size in, and your stop loss placement is where your previous break even place is. So that's how we want to pyramid, right? So how would we pyramid here? Let's say we get in right here, one contract. I guess we'll do 6 here. Hold on, let me redo this. Hold on. Let's come here, right? Let's say here we would have pyramid 6. Would a sell 6 here, right? Now, let's say our stop loss is up here. We're risking just around 1100, right? Would it come down here? You're gonna look for your next order block. Make sure it's in that premium, right? That order block gets formed. We're gonna pyramid one more time right here, 4. Now this is where our position got in. I know it kind of gave us like a shit fucking fill. So we're just gonna have to deal with it, right? So now you wanna ideally risk around the same amount, 1100, right? Which is gonna be around your previous break even point right here. Does that make sense? And then you'll just take it lower, just like so, right? Eventually you'll move it back, you'll move it down to break even whenever you feel comfortable, right? Take your partial or whatnot, like take your partial here, right? Take off majority. I would say take off 80%, 75% of your position on your first partial. If you're pyramiding here, right, boom, take that in here. Let's go one more, get that low if we can. I don't know if it gets that low. Let's just say we take it off right here, boom, right, go back to break even here and kind of just let the rest ride out, right? So you take off your 8 here, your last two you're holding down to for this low right here, right? And then if you get stopped out, you get stopped out, right? You got your partial already, it doesn't matter, right? You got your pyramid, you got out 8 contracts here, dollar cost average right here, which would be more if you were just in 6 contracts here. Does that make sense? So that's how we want a pyramid. Make sure we're not pyramiding after we take a partial, and making sure that we're pyramiding in a premium or discount. You don't want to do it afterwards of your implied dealing range, of course. All right. Any other questions? All right, cool. If you have no other questions, then I'm just going to go over really quickly what I went over one more time at the beginning, right? No live examples, just one more time what I went over at the beginning, and then we'll be done with it, right? So your cell model, to look at this original consolidation, it's not going to be this clean usually, right? Smart money reversal, come back, boom. This is your cell model, right? Quickly, we want our breaker block. We want our standard deviation positions. Where do we want our standard deviation positions to line up here? You want your original consolidation to be at the 2 or the 2 to 2.5 or that 4, ideally the 2 to 2.5. You want your short-term low to be here at the 1.5 area here, right? And ideally you want to see this taken, right? Then you want to see, so for your low risk buy, it's going to be somewhere here. Low risk sell, in this case, it's going to be somewhere here. First stage of distribution, it's going to be here on this breaker. Second stage of distribution, it's going to be at this 1 to 1.5 here. Take out this low. We're going to catch the next fair value gap that kind of forms right here. Boom, that's your second stage. Fair value gap, where do you want to target? Right, ideally, right? If you can hold down to here, there's something wrong, right? Maybe you pyramid something here, take off a partial here, hold here. Maybe you hold it straight out, right? Probably take a partial here. That you definitely want to take a partial here, right? Because this area here, right? It's gonna generally align up with your EQ level. Okay, this was like really didn't make sense, but this is generally gonna line up with your EQ level here. So this is want to be your first take profit point. Make sure it is at least in a discount if you're shorting or a premium if you're longing, right? You want to take your profits at a premium or a discounted liquidity pool, Peter, right? Whatever the fuck you want to call it, right? Boom, if you're taking your first stage of distribution, boom, take profit 1, take profit 2, or boom, full take profit if you want, right? If you're getting in at your second stage of distribution, boom, this is going to be one and only take profit here. If you want to hold the runners because you see relative equal lows or something, or you still think the draw is lower, completely fine, right? Just make sure you have the right context for it. It's how it wants to be, right? You want to see your mitigation block here. Once again, mitigation block does not have to be hit here, right? It just has to be here. Does not have to be here. Yes, this can also be a breaker here too, right? If in the case of we do something like this in here, right? If we do something like this and we make a breaker, that's totally fine. Not a big deal here, right? But that's going to be your mitigation block, right? You want to see it come into the fair value gap, right? If we're heavy, we're not going to come into that mitigation block. 9 out of 10. Probably more often than not, you're not coming back up to this mitigation block. All right, let's look at our buy model. Okay, buy model here, right? Once again, let's draw standard deviations from the breaker block here, right? Let's look for our standard deviation levels to line up properly here. Cool, lined up perfectly here. Okay, let me just fix this a little bit then, so it's a little bit cleaner here. Okay, cool. Once again, here we go, right? Low risk sell, good. Low risk buy here, gonna be somewhere right here, right? First stage of distribution, gonna be on this breaker, possibly a unicorn, right? Once again, does not have to come into this breaker at all, right? Could completely miss it and do something like this and go up. Does not have to come into it, but it can, right? If you're targeting that first stage of distribution, your first take profit or your terminus should be at this low that lists in between the 1 to the 1.5 area here, right? So if you're taking it here or here, right? Idea is this is your first take profit, and then you can have your second one be at this 2 to 2.5 right here, right? If you are getting in at the second stage of distribution, which will most likely happen after you take this 1 and 1.5 zone, after you take this liquidity here, you get in right here, you're going to be targeting here. And there's completely nothing wrong with getting in your second stage of distribution. You're still going to get your money, right? It's just going to be a lot safer option because you're now going to have a lot more context of when it's going to reverse, because it's super easy in a buy model, right, to have something like this happen. You think, oh, this is going to be the smart money reversal right here, boom, stops you out. Oh, it's going to be the smart money reversal, boom, stops you out, right? And then finally takes out the liquidity pool it wanted to, right? Comes up, something like this, and then boom, right? Oh, doesn't want to come up here, maybe 15-minute or something, fair value gap here, right? And then you're going to sell off, right? You're not always going to have this full entire. It's not always going to be like this, right? Like I said, sometimes you're going to have these where it's going to come up here. You're going to get stop run, little Judah saying stop run, right? Then you're going to have something like this where, you're going to have a mitigation block form here, right? And your breaker block is not going to be all the way until up here. Up here, right? Maybe you get on your breaker block here. Let's say you're targeting this high here. This is your 1 to 1.5 high here. Boom, reaches short. Boom, you get stopped out at break even, get stopped out at loss, right? Or maybe you try to get in here. You saw that breaker block form here. Boom, target something like this. Boom, you get stopped out. Boom, you get stopped out, right? So maybe let's look for that second stage of distribution always, right? So what are we doing when we're looking for that second stage of distribution, right? Right, what are you looking for? You're looking for that breaker block. You're looking for the first stage of distribution somewhere here, right? Boom, you get your mitigation block here, first stage of distribution. Boom, right? You take out this high. After we take out this high here, or this high here, right? What do you get? Right, now you can determine, okay, am I confident we're going to go higher? Yeah, it makes sense for us to go higher. Let's look at that fair value gap. Let's take that fair value gap and let's go higher. Now I don't have the idea of, okay, is this going to be the exact reversal? Because you don't have to cash the top. You don't have to cash the bottom, right? Boom. Yeah. And let's say you wanted to take a first distribution trade here. You missed it. That's fine. There's going to be order blocks, right? There's going to be order blocks everywhere here, right? You can probably find a leg up, a pushing block somewhere there. Don't chase price if you guys don't have to. You can always wait for that second stage of distribution. You don't have to get in at the very bottom. You don't have to get here at your lower sell. You don't have to turtle soup something here. Okay, does that make sense? Do we have any more questions about buy models, sell models? Not, then I'm done.